Good morning. Welcome to Heirs United Investment Club's financial training facilitated by the membership. And I'm Meredith McGee, and also I live in Jackson, Mississippi.
All right, thank you. I'm very pleased to be here and to partake in the Heirs United member facilitated training. My name is Evelyn Gordon, and I live in Denver, Colorado, and I am representing Kemet, another family investment group. And the word Kemet identifies one of the most ancient civilizations known to man in Africa. And Ra is the high spiritual energy. So giving honor to our place of birth heritage and giving honor to the Creator. Thank you.
Very good.
Yes, I am Vickie Jenkins, and I am a member of the Heirs United Investment Club. I am here in Jackson, Mississippi, and I realized that it is a financial training, but within the training, we need to know what is the outcome and what it is used to become involved in the training. Because without the training, there is no income. So what needs to be involved in the training? Finances.
Okay.
Hello, I am Joanne Patton, and I'm from Chicago, Illinois. And I am here listening to gathering information on financial investments, and I hope to learn a lot and get a lot of information. Hopefully, everyone watching this will do so also.
Thank you, Joanne and Evelyn and Vickie. Okay, so I actually have I prepared a slide, and thank you, Evelyn, my elder cousin, for pushing me to share, because I always like paper. So anyway, I have I'm going to share the net worth. Since I was doing terminology, I decided just to do really two terms: uh, wealth building and net worth. And net worth is uh, the monetary value of what someone owns. And that's what I'm going to show you. And that is your assets, the value of it, whether it's your car, and the blue book value of your car, and how much you owe on your car, or whether it's your home, the value that your home will sell for on the market versus what you own your home, or if you are clear. And the value of all of what you own minus your liabilities is your net worth, whether it's negative, positive, low, high. That's how you determine. It's just simple math. You add all the assets and you add all the liabilities and you subtract to see whether it's a positive number or a negative number. Okay, so I'm going to share this. I did two hypothetical homeowners. One, I imagine, was someone who was just getting in the home, maybe had been in the home 6 years or so, and another one that was almost done, maybe that length of time left to pay it off. Okay, so I'm going to share this. You guys see it?
Yes.
Okay.
Mm-hmm.
So we have here the net worth of homeowner number one. Okay, so hypothetically, the value of their home is $125,000. They still owe $70,000 on their home. The blue book value of one of their cars is $6,000, but they still owe $20,000 on the car. Then the blue book value of another car is $5,000, and they owe $8,000 on it. Now this person has accumulated a lot of jewelry. The value of the jewelry that they own, I'm assuming a lot of it is gold, since gold is very high now, is worth $40,000. And they have been saving a lot of money. They have $155,000 in mutual funds. And they have a pretty nice art collection that is worth $43,000. So adding up their assets, $374,000, and subtracting their liabilities, $98,000, this homeowner number one net worth is $276,000. Homeowner number two, they haven't been in their home quite as long as homeowner number one. Their house is valued at $150,000, and they owe $250,000 in interest and fees on the house. They also purchased a half-acre lot, which is worth $6,000 in their on their street. They have a truck which is worth $20,000, and they owe $8,000 on it. And this homeowner number two has accumulated or either inherited a lot of antiques, which is valued at $40,000. They have an iron with $75,000 in it, and they own a couple of gold bars valued at $6,000. So their assets is $297,000. Their liabilities is $258,000. So this homeowner's net worth is $39,000. Well, when was the last time you all did a tabulated your individual net worth?
For me personally, I would say it's been, boy, probably about 10 years. I really haven't looked at it in a while. And I don't even remember at this point in time what it was back then.
Yeah, I know what you mean. They say
a lot of things have changed. Yeah.
And they say that financial analysts say you should do it once a year, because actually everything changes. And even the value of things, your house will go down, it can go up. The blue book value of the car goes down based on the mileage and things like that. But anyway, while I was doing the net worth, I ran across an article on President Biden, and which looked at his income, and since this is his second day, I thought it would be nice to share a few points about it. The first thing that I thought was interesting in this article was that when he first became the youngest senator in America, I think he was the youngest one at that time, and his salary was $42,000. And then moving forward in 2009, when he became the vice president, his salary was $169,000. No, his salary had advanced from $42,000 as a senator to $169,000 as a senator by 2009, but it was in the 70s when he was became a senator. And then when he became the vice president, his salary increased from $169,000 to $225,000 a year. And it says that his net worth was between $897,000 to $489,000. And when he stopped, when the 8 years ended, he and his wife, one of them had booked deals and tours. I think it was Dr. Biden, Jill Biden memoirs. And then they earned like $15 million in speaker fees. And so in 2001, the presidential salary doubled from $200,000 to $400,000. And in addition to doubling, the presidents get a $50,000 a year allowance and $100,000 non-taxable travel account and $19,000 for entertainment. And I thought, they allow all of these amenities for someone who doesn't have to pay rent, and they fuss on in this pandemic where you have people in food lines giving out $2,000 to ordinary people, which I know this is not political, but what I also found out in reading was that actually in 2020, the year, Joanne, you asked me that in the last session, and I did some research and looked it up. The year 2020 started in the bull market, which is price was rising. Then after, I think maybe March or so, it became a bear market and everything started going down. But they said it was, I read that it was one of the shortest bear markets in history. And they said that actually the first stimulus, which the Federal Reserve did, and they also took interest rates down, that got us out of the panic, which Evelyn mentioned is the mood of how the economy is. And then we went back into a bull market. And I thought that was interesting. And before President Biden got in office, his promise for expanded vaccinations helped the economy become healthier. And then Vickie is going to discuss that in her session. But anyway, that's all I had for my presentation. So if anyone has any questions, feel free to ask them or comments.
Yes, I have one comment. First of all, thank you for the information you've provided. It certainly is a stimulus and a reminder for us to each do our own net worth. And the question that I have is concerning the second homeowner that you had up there on the screen, where the value of the home was less than the amount that's owed on the home. And so what that says to me is, I don't know, perhaps the value had not been calculated appropriately, or, you know, I couldn't help but wonder what's going on in that situation, that a person is paying significantly more than what the home is valued at. Can you comment on that at all?
Compound interest. when anyone gets into a new mortgage, they are upside down, usually automatically, if all they paid into the house was the down payment. They had no equity from another home to go in it, or anything. It takes, it takes so many years to pay the interest down and start working on the principal. So it's just a matter of being upside down. And for most consumers, when we do anything, we're upside down because we're not high end earners like politicians. It's those kind of, and we don't get the kind of benefits that they get, and we don't get expense accounts and that kind of thing. Yeah, so it's just it's basic math. When you first get in the home, you're upside down.
Okay, thank you.
Mm-hmm. So was there any other question or comments? If not, I defer to Evelyn. She's going to do her presentation, and thank you so much.
Okay, so what I'm going to do is I'm going to attempt to, I have my presentation, or at least some notes for my presentation on a laptop here. I don't have it on the screen, so I'm simply going to talk through it. Hopefully that will be okay. The information that I'm sharing comes from what's called the U.S. News report, and it's specifically from the money section, and I believe this was in 2014 that this particular item was put together, and it's entitled "The 7 Do's and Don'ts for Rookie Investors, for New Investors." So even though there are some people in the membership of Heirs United who are seasoned investors, I thought it might be a good review. And then for other folks who really are real new investors, hopefully the information will be of benefit. So for those taking the initial plunge into investing, it could be a little off-putting or nerve-wracking if in fact you don't have good guidance, or kind of feel like, I don't really know what I'm doing and I don't want to lose my money. So here's some tips that might be helpful to you. The first tip is a to-do, and that is to do a ton of research. So before locking your hard-earned dollars into a stock, a mutual fund, an exchange traded fund, or any other type of market investment, be sure it's worthy of your money. Television shows, radio programs, articles, and other sources of investment advice could be helpful in pointing out to you the right direction to go in, but they should serve as only a starting point or as one piece of information. You should seek out several sources. So choose someone to help you manage your investments and be sure to lean on them for information. And you don't have to do this process alone. But the same amount of careful research that you put into choosing your first investment should also be applied to choosing a financial advisor. So the strong advice here with this first item is that anyone who is investing should have a financial advisor. You should not be doing it in a vacuum or by yourself. The second tip, don't try to time the market. Reason being, according to the information I'm looking at, that's impossible. You cannot time the market. As the most famous and well-respected investor of all, Warren Buffett, wrote in one of the Berkshire Hathaway, wrote a letter in the Berkshire Hathaway to shareholders. He's quoted as saying, "The goal of the non-professional should not be to pick winners. Neither he nor his helpers can do that." In other words, your financial advisor cannot absolutely, without fail, always pick a winner, but should rather be to own a cross-section of businesses that in aggregate are bound to do well. So in other words, you're looking at investing money across many different segments, and some of them are going to be high earners, some are going to be low earners. But if you're always looking to pick the investment that's going to be the highest earner, according to this, more than likely you would not be successful. That's almost impossible to do. Some are just going to be higher earners than others. The third suggestion is to diversify your investments. Too often, new investors mistakenly equate the concept of diversification with owning many investments. However, a diversified portfolio should not be varied only in number of investments, but also in types of investments as well. For example, a portfolio of only stocks would be too aggressive, even for a 20-year-old. A tech-heavy collection of investments would make your nest egg far too reliant on the performance of just one industry. So this goes for investing in company stocks too, considering that you are already dependent on your employer for your livelihood, your salary, your benefits, perhaps your 401k. It's safe to say that you're already invested in it. So allocate a significant portion of your portfolio to the same company, and you become dangerously dependent on that one investment to pan out. So the whole suggestion here is to understand the concept of diversification and to always diversify versus putting all of your eggs in one basket, so to speak. Okay, number 4, don't invest according to emotion. When the market crashed in 2008, it was working for a financial planner. This particular person was working for a financial planner who had about 100 high net worth clients. The clients watched the value of their portfolios get cut in half within just a few short days, and most did what any normal person would do. They panicked. They wanted to pull their money out before any more of it disappeared. Those who waited out the storm at the advice of their advisor regained all the money they lost and then some. Those who bailed when the money was at its lowest took huge losses that they might never be able to make up. So positive emotions can be just as destructive to your earnings. Don't fall in love with an investment that isn't performing with the hopes that it will regain value someday in the future. There's no place for love or fear in investing, only calculated decisions based on data. So I think that's important because sometimes we form a personal attachment to certain investments and we don't realize it. Number 5, do pay every close attention to fees. On paper, your returns for the year might seem impressive. Unfortunately, once you subtract all the fees that are paid to purchase and manage those investments, the yield starts to look a little less exciting. In fact, you could easily end up sacrificing 40% of your return to fees. And this is according to Forbes International that's making that statement. Trade commissions, expensive ratios, advisor fees, they all add up and take a big bite out of the earnings. It pays literally to research the costs associated with all possible investments before you make the final decision. Okay, number 6, don't wait. Think you can make up for lost time by investing more money down the road? Thanks to compound interest, you would still earn more over the life of your investments by investing less now than a bigger chunk later. Add inflation and increasing lifespans to the equation, and you can't afford to give that money up to procrastination. In other words, if you're going to make an investment, go ahead and invest. Usually waiting is not going to be beneficial. If it looks good, then you should move on it. Maintain your cash savings. Finally, and this is the last, number 7, it's very important to understand the objectives of your savings and how to put it to work based on your goals. Market investments are for the long term. Money you would need for at least 10 years or ideally longer. Retirement is a perfect example. Okay, so a separate cash savings account should always be maintained for immediate needs. After all, because of the time, fees, and future earnings sacrifice, your least desirable option for covering a new transmission or a roof repair would be to sell off shares of an investment. In other words, you don't want to put yourself in a position where you have to sell shares of your investment in order to take care of your daily living expenses or some emergency that comes up in your life. You never want your emergency savings to be tied up. Keep a minimum of $10,000 in any combination of savings accounts and short-term certificate of deposits. That should protect you from surprise expenses that need to be covered immediately. So those are the 7 tips for the new or the novice investor. I found them to be not only just interesting, but very practical. So thank you for the opportunity to share this information.
Thank you. Now, what was the 7th tip?
Okay, the 7 tips, let me go over them again, starting
No, the last one, number 7.
Oh, I'm sorry, the very last one. Okay, the very last one is that you are supposed to maintain always a cash savings. It is recommended that it be no less than $10,000. so that if there's ever some type of an emergency or a personal need that has to be cared for, that you won't be tempted to sell off your investments in order to cover if you need a new transmission in your car, or the roof starts leaking, or whatever.
Yes.
That you can keep your investments, but go ahead and take care of whatever your needs are.
Yes, absolutely.
Okay, thank you.
Okay. Vickie or Joanne, did y'all have any questions to ask Evelyn?
I would just like to ask, how do you choose a financial advisor?
Well, what I can share with you is I think the choice of financial advisor, or what I have done, is via reputation. By talking with other people who are investors and finding out who they have used to do their financial advising, meeting that person and having them share with you kind of their philosophy, how they work with people, and making a decision. And it's primarily based on their track record of how successful they've been with other individuals. That's been my experience.
And some people use people that charge you per trade to buy stock for you. And I want to tell the audience, if you're just joining us, this is Heirs United Investment Club financial meeting, and we're all members. And two of the members are members of Kemet Raw, and Evelyn just did a session on the basics for financial for new people that are just beginning to invest in the market. Now, I know that Kemet, you all have been with Kemet Raw since the beginning, and I've been with Heirs United since the beginning. And Heirs United has never used a financial advisor, ever. We do our own research and select our own stock. But I know that there are some investment clubs who do use financial advisor, or they use someone, even if we buy stock, we buy it directly. But uh, most most investment clubs are set up that way, and that's where we get our model from. Uh, During the monthly meeting, the members research stock, and then and mutual funds, and then they buy buy them, and then yes, the portfolio, the nest egg, whatever you want to call it, it should be in different sectors. You have large cap companies like the S&P 500, and you have um, middle-sized companies, and you have small companies, then you have technology, you have um, energy, you have a gold and precious metals, you have different sectors, and the nest eggs, as Evelyn would say, should have the money spread out, and everyone should have an emergency fund so that they will not have to sell off stock if they have to buy 4 new tires or a water heater, or get a lawyer, or whatever they need to do, because you got, this is a cash society. And that was the only thing that I wanted to say. That was a very good tips, and I just love Warren Buffett. He gives great advice, and he shares so willingly all the time in articles and everything.
Mm-hmm.
Was there any other questions of Evelyn?
I'd like to add just one thing, And that is, as far as Joanne's question around the financial advisor, what I have found personally is that a financial advisor, at least I have found it to be helpful, to work with a financial advisor who is going to assist you in terms of your total financial picture. In other words, your total life goals and what your finances need to look like in order to get there, you know, will help you from the standpoint of looking at not just what's happening with the market and let's make this investment or that investment, but let's look at everything that's going on with you from a financial perspective, and how do things need to look in order for you to get to that goal. These are also individuals who help to educate you and who are in a circle of other individuals whereby if you need legal assistance, they can refer you to some sound legal advice. They can refer you if you need to do planning, whether it's creating a trust, making out a will, taking care of property issues, that they circulate in a circle of people where they can not necessarily be an expert in that area, but put you in touch with good, responsible people that they work within that area. So a financial advisor is a key to being able to have access to good professionals in many different arenas, as well as financing. So, you know, that's another piece around choosing a financial advisor.
Thank you.
Okay, if there are not any other questions, Vickie, are you ready?
Yes. all of the details and reports and everything are very good for investments and financial wealth, but we should not look at the impact financially on the other segment of not the rich and the wealthy and of the country, are low income people who has to work to build the investments. I know somebody has mentioned about the tires in the house, skilled workers involved in the house and the cars. They are in dire need of the financial investments. The government has an unprecedented policy impact to people and business. The effects of these measures are likely to affect long pandemic virtues, impact of establishment, formation and sustainability, and reverse of businesses has remained low. Health fears, health fears, health fears, and see, I got cut out. Health fears, medical crisis, and social distancing are creating a significant effect on the workers and the working class people. The low income workers, unskilled, who want jobs are $4.5 million. 4.5, I should say million, 4.5 million. Global trade, global traveling has somewhat increased the likelihood of business and company behavior. However, 1 in 5 households with children has a very low savings and loans and savings account. 1.1 out of 5 low income unskilled workers who want jobs are extremely at 1.5 million, and they stand at a relative level. 1 in out of 5 million households fear lack of food, lack of medicine, lack of household equipment, lack of those who do invest. And forgive me wrong if I'm talking negative about those who do invest, which is necessary. But on the other side of the investors, need of workers and business owners to help in the investment, because if there are no workers and businesses, there is nothing to invest from. Yes.
Okay, was that your presentation, Vickie?
That was my presentation.
Okay, so were you saying to us that in this pandemic, there are so many people unemployed and needing jobs, and the businesses are doing poorly, that people cannot invest? Is that what you were saying? I was trying to understand.
Well, I'm saying that does affect investment, because if there are no cars, houses to invest in, there are no skilled laborers to build houses, to make cars. All of these things are in effect with each other. Nothing can be done without one another, is my point. And my point also is that unskilled 1.5 million workers who want jobs are not available for everyone. The unemployment checks are low and slow in coming. All of that is effect in everything. One cannot do without the other. That's my point.
Yes, people are suffering.
If I could make a comment, I think what I hear you saying, Vickie, is that the economy that we're in right now has been severely impacted by the pandemic, to the extent that the stock market, if it has not felt the impact already, that it will start feeling the impact of all of these businesses that are struggling financially. And of course, the snowball effect of that is that people are laid off. And so if we have small, medium size, and even medium to large size businesses that are no longer able to produce services and products and to make a profit, that is going to show up on the stock market. And so I think that's what I hear you saying, that the stock market is just not going to be as robust. And so as we continue to look for investments, to be mindful of that there may not be anything stable to invest in until those businesses are able to get back on their feet and to bring the workers back to work.
That is correct. What is there to invest in if there are no businesses that are robust and are hiring and employing those workers who are really looking for jobs? That's my point. If there are no, let me stop.
Okay, well, let me, can I chime in? You know, I told you all I read the article about this year we're still in a bull market. The part of America that owns land and has a good network and they have their investments are still they're still smiling when they look at their statements. And there are always good things to invest in. Last year, I read that we started with a bull market, prices are rising, stock are rising, then we had a brief bear market where it was in decline, and once they did the stimulus, things came back, and the things are still good. There are some
How,
sectors that have
excuse,
been impacted, but that has not kept people from making money in the stock market.
all I'm saying is, I know you were talking about all the land and everything that has, but you still has to have someone in connection with the land that does make it, because land does not make it without some businesses. That's my point. I'm saying I really realize that the stock market is is increasing. However, the stock market has crashed at some point.
What
And
it had it didn't it
it
hasn't
did crash.
crashed. When it crashed?
There was a crash back in it, but there was a crash in '87.
Oh
That
no, I'm
was a
talking about
severe.
no. I'm talking about yeah. We had crashes historically, but we're not in a crash, a stock market crash. We in a crisis with economic crisis, economic crisis in this pandemic. The most of us at the bottom of American society are our lives have crashed from unemployment and the small business. Some of the small businesses have gone out, especially people who were dependent on in-person customers. But the people invested in the stock market are smiling at their statements. Who have diversified holdings, Lowe's went up during the pandemic. Gold went up. There's some things that went out, but not some things
So,
just soared. Netflix and things
excuse
like
me,
that are the
am
places.
I hearing that the pandemic and the low market value and the globalism trade has nothing to do with those who are investing and are at a higher level of their investments? That's what I'm hearing. And my point still is how high you are reaching your investment, which is good. My point is that you can't have all of your investments, high as it may be, land, all other machinery, land and everything cannot be maintained. That is my point. That that's the point I'm making. Not to say that it's not there, and not to say that it's not there and it won't be there, but it cannot be maintained without those who do maintain, because you got to have somebody that's maintaining the land that you own. You got to have somebody that maintains that land.
Yeah, somebody got to maintain the land.
Yes, I mean you own land and have and yes, and you do have land that you have in your portfolio. But if you don't have anybody, how is the land maintained to be at a profit level? How is it maintained? Because it does have to be maintained.
Okay. So, are there any other questions from Vickie's presentation or comments?
As you can tell, I'm very I'm very much in tune to what this is because I really do think so.
Okay. Well, very good. All right. So we started off talking about net worth, which is the value of a person's assets minus their liabilities. And Evelyn talked about the basis of basic things that a new investor would need to know. Like, for instance, everyone should have an emergency fund of cash, and her research suggested that the emergency fund should have $10,000 in cash sitting somewhere, or cash equivalents, so that you would have to sell your stock. And Vickie
Hello,
talked about
I'm sorry.
land.
Where do you get that $10,000 from? That's my point. Where is it? Is it investment? Is it you invest in something? Where do you get the $10,000 from?
She's
And
talking about
from your
cash.
assets.
No, she's talking about cash. An
Well,
emergency
you still have
fund.
to make your cash from someplace. Someplace you have to make your cash from.
Right. She's
Now,
talking about saving the money, the savings. Some
you
people say
still
you
have,
need some people will start with $1,000 emergency fund and just keep adding to it. And her advice said $10,000, but it's cash for emergency, because in the capitalist society you have to have cash for the water heater and all that, the four
but
tires.
where do you get your
Whatever.
cash from?
You
Cash has
save
to
it.
be
You save it
earned.
monthly. You say you put $50 a week, if you can afford it, into your to a fund, and then you take some and put in your emergency fund. You take, and then you can start investing when you build uh, uh whatever you feel is a good emergency fund. Some people have $3,000 in their emergency fund. Some people have 1,500. Some people have 5,000. Some people have
But
10,000
you also
as
have to
suggestion.
know that. You have to know that. That's what I'm talking about. Is you have to know that and learn that. If you don't know, then that won't take place. That's all my point is. You have to know that.
Right, that's the purpose of financial training. Is that we're just one of many investment clubs. They have meetings every month to talk about financial literacy and the stock market and mutual funds and stock and bonds or whatever it is they're interested in. And I've enjoyed the research that came out of this session, and I think that it's very valuable. I think Vickie, she must have hit her.
Yes, it
Vickie,
did.
okay, we're waiting on you to come back. And we was getting ready to end anyway. It's about 12 noon. Here,
Oh,
what
I'm
time is it
sorry.
in? What time is it in Denver?
It Denver is on Mountain Time, and right now it is 11:03.
Okay, and it's 12:03 here. Oh, it's just 1 hour different.
Yes.
And Joanne, you in Chicago? You the same time, Central Time?
Yes, 12:03 here.
Yeah, that's what I got. 12:03, and Vickie Central Time too. 12:03. Well, so let's just each say something very valuable that we got out of the session today before we end. And anybody could start from or either any of the research you did yourself. It doesn't matter.
I think the most valuable thing that I got out of the session today was reinforcement in terms of the need for financial education, particularly in our communities. Financial knowledge, financial management, financial education is not something that is just automatically passed on. It's not in your DNA. And so you have to make an effort to attain some level of financial literacy in order to be able to navigate in the environments that we live in today. So this is a great service that's being provided to our communities. And the thing for me is knowing that it's here and being able to continue to take advantage of it.
Very good. Anybody else? One valuable thing that you learned from your own research or from today's session?
I would just like to say that I think this financial training is important, and just knowing the basics of financial literacy will hopefully encourage people to learn more and get more information. But I feel that it's very important. I learned a lot.
Yeah, me too, Joanne. I really did. And you, Vickie?
Well, yes, I am in tune to what we're talking about, the financial investment, because I am one of them and I do have assets. But I still realize, and I guess because I work with the quote unquote criminals, I do realize on the other side of what it will take to do so, because I need workers to maintain my assets. That is my point. And I know about investing, but I'm still saying that some are needed for your investment. That's all I'm saying. Yes, I have learned that.
Okay. And so when I did the research, the thing that really struck me is that when I read that last year it started off a bull market, prices going up. Then we had a short bear market, the stock market going down, and then the stimulus money actually took us out of the bear market, and then we ended up in a bull market. And then even before President Biden announced that he was going to do this 100,000 vaccines and 100 vaccinations in 100 days, that increased the market. And it goes back to what Evelyn was talking about in our last session, is that people panic when they're afraid. And when people are not panicking, the market gets upset if people are panicking. And the other thing is that it's not good to panic. And overall, it was a very wonderful session. So I'm going to upload this to our page. Thank you all for coming. And next month, we could do it on our regular time, which is the fourth Saturday. We had to deviate because of conflicts tomorrow. And thank you for coming. And you all have a great day.
Did you say the fourth or the first Saturday?
Fourth. We've been doing it on the fourth Saturday. We had to do it on Friday before the fourth Saturday because of conflicts tomorrow. Thank you for accommodating the change of date. And
all right.
So we'll whatever topic you want to do, feel free to do it next time. I think I'm gonna stick with terminology. I haven't even gotten but 5 terms. 5 terms.
Okay.
Sticking with that subject.
All right now.
All right.
Okay. Thanks, everyone. Bye-bye.
All right. Bye-bye.
Bye-bye.